All right, so we are looking at another session together here. So I titled this one, Romancing the Uncertainty. Now, I always try to come up with some kind of little clever title to get you guys thinking about what this potentially might be about. Where am I going to take it? How's it apply to you? How is it applicable to you as a trader, as a student? And I think that the 2024 mentorship so far has been, at the very minimum, illuminating in the aspects that price is predictable, the conditions around the marketplace is predictable, high probability and low probability can be determined, framed, and you can learn to anticipate when it's probability that is against you, when you're going to have more adversities than you would care to have any other time. Usually it's the times when you have hurt yourself, draw down, blown accounts, confusion, high anxiety trading, high anxiety analysis without even pushing the button, and not really understanding what causes it. And you're learning now how to place more emphasis on determining the characteristics of the marketplace that you're trying to either trade in, or that you're going to be comfortable saying, you know what, I can see the price is fluctuating just like everybody else around the world watching that same price. But I know enough about myself, I know enough about my model, and I know enough about the inherent risks, the uncertainty of profitability in certain financial climates. That means, is the market predisposed to hurt you and anyone else that participates in it? And that's kind of like the emphasis for new students on non-farm payroll week. That's what I'm trying to capture your attention in regards to the unrealized, until it's too late, risks that comes with trading that week. Everybody hears the success stories of how someone did this and someone did that on non-farm payroll. I made this much money. I made that much money. I'm able to get a withdrawal for this much money because I killed it on non-farm payroll. And you're learning that there is a lot more to it than just getting lucky, surviving that carnival ride. And while most retail traders, people that use logic that has no bearing on why price is going to go up or down, they will subscribe to the view that, hey, their techniques, their models, even my concepts in the hands of other people, they may sell the idea that, hey, look, I got it all figured out. And as I mentioned, every single time I've ever talked about non-farm payroll, I said the same thing Friday. I said, you don't know. No one knows where it's going to go. And inviting ruin, inviting the potential for the market to just start spooling and running way beyond where you think it's going to go. Ignoring that underlying risk, ignoring it, discounting it, thinking it's not going to happen to you. Not this time. You're romancing the uncertainty. You're only looking at it from the perspective that it's going to be good for you. It's going to be good. It's a good thing for me to do this. That's what you tell yourself. That's what you're thinking. In reality, you're most likely anxious. That's why you never said anything in front of the public about what you were doing. But when it works, you're going to come out and show your market replay execution. Look at this. Look what I did. I killed it. If you were that confident, you would have done it live. You would have done it in advance. And the fact that you won't do that, or that you see other people doing it just like that, it's cause for concern. You're spending too much time doing the wrong things, worrying about the wrong things, and romancing the uncertainty only seeing it through rose-colored glasses as an expression that you can only see it your way or the good side only, and not realizing the underlying risks that are associated with it. So I want you to think about what you watched this week. I want you to think about how we were able to navigate. At the beginning of the week on Monday, I told you what the weekly objective would be. And once it delivered to it, guess what? That was it. We were looking for that weekly buy side and balance, sell side efficiency that we traded down into. And it was just off by a little bit before closing it entirely to the downside. And that's all it did. I want you to think about how I took you into the charts live and showed you executions, buying and selling, emphasizing that the downside was really where we were focusing on. That was proven to you on Monday's top-down analysis. But buying and selling, executing on a short-term basis, just trading the intraday volatility, using any immediate lower time frame, 15-second or 1 minute fair value gap, and conditioning yourself to just see it and execute on it. See it and execute on it. Place a stop and a limit, and submit to both. Whichever one happens to be hit first, that's what you're going to subscribe to for that exercise. And you desensitize yourself. See, that is the right thing to do. Not going in thinking it's always going to be an outcome that's favorable to me. You need to remove that thought process entirely. You need to remove the necessity for the outcome to be positive for you. Because if you focus on that in the beginning, while you're discovering who you are, what you're going to do to wreck yourself, before you discover your character flaws, every one of us have them, you won't grow efficiently in your understanding. You won't have an understanding of what you're trying to become. Because in the beginning, you really don't know what you're trying to do. You don't know what your ending model is going to be. You don't know how you're going to perform as a career trader. You're not going to understand the things that you don't know yet, because you don't know what you don't know. And that uncertainty for you isn't being romanced. It's being explored. It's being navigated. Much like Christopher Columbus, who set out and discovered America and whatnot. Imagine how scary that would have been for him. Do you think he was trying to talk himself out of it all the time? Or was he thinking, how amazing is it going to be once I discover something new? And he submitted through the process of discovering it, getting out there in the uncharted waters. The hard right edge of every single chart, every single one of them, that hard right edge, that's the retail drowning pool. You see so many traders now. Go on social media. Look. There's stories of regret and woe. I blew my accounts. I lost my funded account. I failed the combine. I don't know what happened on Friday. Why was the market so hard on Friday? Why was the market so choppy this week? The market was trash this week. That's the retail drowning pool, that hard right edge. They want to believe in their fairy tales and myths about why price does this and does that and what indicator causes it to go up and down. But none of them spend the time, like I've been teaching you, to focus on when it's going to be less likely for you to succeed. You're not romancing the uncertainty. You're removing any emotion about that hard right edge. You're looking at, why would price go up? Why would price go down? Who is it going to hurt? Because that's what this game's about. It's about taking. It's about overtaking and devouring. That's what it's all about. It's nothing else but that. And your indicators are going to crunch numbers and spit out some data that you're going to subscribe a religion to. If you're a retail-minded thinker, you're placing faith, almost to the degree and level of religion, over these indicators. like they're somehow going to cause price to bend to their will. Stochastic says you got to go up. RSI diverge. That means you can't go any lower. You cannot go any lower. You might as well just start going up right now. I used to talk like that to my charts. As a 20-year-old, I said, there's no way they can keep going down. It's diverged twice. It's been oversold for hours. It has to go up now. Everybody sees the same thing, so they got to be doing what? Buying it up. And everybody buying it up should cause it to go higher. Yep, that was me being religious about price action. And that was also me losing money. That hard right edge is no longer scary to you, because you understand where you're at in price relative to the dealing range, the seasonality, what month of the year you're in, what week of that month you're in, what day of the week you're on, what the economic climate is for that week because of the economic calendar. And you're learning how to navigate uncharted waters. You don't know if there's any rocks just beneath the surface that might strike the bottom of your vessel and cause you to sink, but you're not obsessively worrying about that either. You're exploring the uncharted territory of your future self. And while that is exciting, you have to tame that overzealous nature that, like a child waiting on Christmas morning, they can't wait to get up and see what St. Nicholas left them under their tree. What presents are the market makers going to lay in your hands today as a profitable trade? The market maker doesn't let you sit on his lap and ask for what you want for Christmas. It's designed to consume you. So when you adopt the mindset that cannibalizes retail thought, then you are outside of its reach. You're just outside of the influence and the religious perspective held over price that indicators and retail logic presents. It takes more faith for people to believe in those things than it is to simply study price action naked and study it through the lens of time and price, inefficiencies, liquidity, seasonality, all those things that are factual influences. These are things that really have an influence and effect over price. And they can be scheduled as a time when you're going to engage the marketplace, because there's an economic calendar that you can look at and say, hey, there's going to be a lot of volatility this day. This specific day of the week, there's going to be lots of volatility that day. And if it happens to be on the latter half of the week, well, you understand now that the cleanest price action is going to be where? At the front of the week. And the retail crowd, the casino goers, the gamblers, the less informed street money is going to be out there on Thursday and Friday pressing really hard to try to do something amazing when the market's more likely to do nothing in their favor but hurt them. Take a look at your chart on a 15-minute time frame. Look at the NASDAQ. Wednesday's trading, Thursday's trading, and Friday's trading. Contrast that with Monday and Tuesday's trading. Whole lot different in terms of how price was delivered. Do you want to be in a market that has difficulty? The difficulty in producing low resistance liquidity runs, where the market just runs quickly, expediently, right to your targets with very little, if at all, retracements. Hardly any consolidations, barely any pause whatsoever. It just runs quickly and goes right to your target. Or do you want to be in a market that has to be babysat? And you're constantly concerned about, Is this retracement going to be one that stops me out and then eventually goes in my favor later on? That's trading in high resistance liquidity runs. See, there's a benefit in understanding the lay of the land. Knowing how that economic calendar is going to impact future price, days that haven't even started yet. You're looking at these things on the weekend, anticipating how the week's going to be problematic on certain times and days. But retail's not thinking that way. They go in and they're hoping that their harmonic patterns are lining up. They hope that they're seeing their indicators become oversold or overbought. They're waiting with bated breath that their moving averages are sloping in the direction they want to be buying or selling in. Where you are different. You're calm. You're calculated. You're patient. Because you know that given day, there should be some kind of opening imbalance, some kind of difference that's significant from the previous day's settlement price to 9:30's opening price. And to the degree of how much of an imbalance is created by that, you get intel, you get information that tells you more about how that daily candlestick is going to deliver. And you understand that if there is a opening price higher at 9:30 a.m. New York local time than that of the closing price at 4:14 p.m. Eastern Standard Time, previous day. If it gaps open higher, and it's a significant gap, you know that there is, in the first 30 minutes, statistical probability that's 70% over the last 40 years. That in the first 30 minutes, that your short-term bias should be bearish in that instance, trading down to half of whatever that gap is. Retail doesn't think that way. They don't go in anticipating something like that. Retail sees this. Well, we gapped open higher, so that means it's strong. Let's buy it. If you measure the relationship between where we closed the previous day, and this is something for you guys that like to make indicators in PineScript for TradingView. Here's a challenge for you. Ready? Create an indicator that plots a cumulative line. Okay. And you want to plot it with measuring the rate of change between previous day's close to today's opening price. And you can start with a number like, I don't know, use a value like 10,000 or 100,000. And then today's opening price, how many ticks is it above previous settlement? How many handles is it or points above it? And you would add that many to that original starting value. And then every day, plus or minus, you're adding or subtracting to that. And it's creating this cumulative line. Eventually, what you'll start seeing is that's measuring the public's perspective. Because they see, oh, we opened up higher than the previous day's close. That's bullish. And they will want to do what? It's higher. It's strong. Let's buy it. Buy.